I'm Rich Harvey, CEO of Propertybuyer. As we head through autumn into the winter months, there's a notable change in the property season. The market has finally bottomed out and we're now in the recovery phase. Auction clearance rates are holding steady around 75% in both Sydney and Melbourne as buyers fight it out for limited stock. Stock levels are down 25%, which makes for tough buying conditions. One of the reasons that we target off-market sales to give our clients the best advantage. Consumer sentiment rose rapidly in April, surging 9.4%, which was largely driven by the Reserve Bank's decision to pause interest rates. Now, we may or may not see a final rate rise in early May. Another leading indicator is the Time to Buy a Dwelling Index, which rose 8.7% in April. This index has now lifted to be 43% above its low last November. Another noticeable trend last month was the rapid revision of property price forecasts by the bank economists who'd predicted up to a 25% fall in prices. Now they're de-escalating their bearish forecasts to suggest a much milder 10 to 12% decline, and now forecasting moderate increases in the year ahead. The biggest factor driving the property prices now is population growth, underpinned by surging migration. Did you know that between 2011 and 2021, the annual population growth rate was 391,000 per annum? Over the next decade, up to the year 2023, it's likely to be much higher at an estimated 487,000 per year. So this means population growth over the next decade could be 24% higher than the past 10 years, with an extra 95,000 people all needing housing. So if you think the traffic was bad when school holidays ended, just wait until our population has ramped up a few more million. For homeowners and property investors already in the market, this data is simply pointing to a bigger Australia and should give you greater confidence in the fundamentals of the property market, being a super solid investment strategy. So where to from here? Well, the RBA will be watching inflation figures like a hawk and may pull the trigger one more time if they think it's warranted. And this might have a temporary negative impact on consumer sentiment. But the only way for our property market to normalise is that the supply of property has to increase, both from new listings of established property and the construction of new dwellings. But that's not likely to happen anytime soon. In the absence of stock levels rising, the obvious outcome is that rents will continue to skyrocket another 15% this year, and that housing prices will also commence rising moderately. So it's far better to be in the property market than watching from the sidelines. I'm Rich Harvey, thanks for watching.